Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Econ Show, we're going to cover a lot of ground, but we're going to try to break it up into something that's sizable and try to walk through a natural flow. So the first part is going to look at high frequency data. We're going to look at what is the new U.S. stimulus bill, what could change, how is this going to direct kind of GDP growth as we head into next year. And then we're also going to look at debt to try to understand, okay, well, what is debt doing? How are we going to afford all this? And then, part two, segment two is an interesting one because we're going to look at jobs, and then we want to look at spending because a lot has been made about how everybody has savings and savings is great, and it's like, okay, well, who has savings? Where are they going through those savings quickly, and what does that mean for unemployment now that we've had some of the new data come out today? Segment three is going to go through U.S. econ data, looking at some of the recent upgrades and adjustments that we've seen through Fed updates. The fourth segment is going to be Europe. What is the new strain and what is the UK doing in terms of activity, British exit, and then in the last segment is going to look at Asia in general and some of the geopolitical updates that we've seen as we prepare for the new year. So, before we get in, we'd like to remind you we do have our end of year report. So please reach out for a sample that contains what's in it, and then obviously table of contents. And then please like, share, subscribe. Your support is always appreciated. So just to kick off some of the updates that we've seen for the daily activity indicators, there hasn't been too much change. There's been some stabilization in advanced economies, which has been a positive. That's something that's going to start to slip again, though, as we see lockdowns accelerating in South Korea, Japan, and Europe, just because of the new strain, some of the new spreads, and that'll weigh on some of the advanced economies. We've seen some of this flatlining in the emerging markets. Now, once we take out China, and it's just because we've seen some slowing of activity as we've been talking about. As imports slow and as advanced economies remain sluggish, that just essentially acts as a drag on the emerging markets. And China is the one that's the interesting component because as we've been talking about the supply side versus demand side and what we're seeing in terms of just local consumption, which continues to disappoint to the downside, which is why over the last about 6 weeks, we've done a deep dive into different parts of the Chinese political theater. What are they doing with debt? What are they doing to try to stimulate? What are they doing on exports, imports? Because that's a kind of a big driver as it's very one-sided as some of that growth. Then when we break it down a bit more into the daily activity in emerging markets, you can see that we were getting this kind of stabilization around, let's call it between 77 and 83%. And the biggest one for us has been India because, obviously India had a nice little increase going into the festival season. And as they come out, they've kind of slowed down, and we're seeing this ripple effect where we're not seeing the same type of activity return, even though things should start to normalize. And we'll go through some of the impacts that we're seeing on the consumer side, as well as some of the impacts we're seeing on just general trade, which we talked about last week, but go a little bit deeper into inflation and what can be done to stimulate that economy. And then when we look a bit more on the daily activity indicator side, so we talked about this in the EIA segment 2 to really kind of hone in on refined product demand issues, oil demand issues. But again, this is also something that is going to really dictate economic activity. What are we seeing on the consumer level, the industrial level? And we've seen, obviously, France had a nice bounce back, but we're starting to see some of that roll back over. And now Japan is starting to turn back, and we're starting to see South Korea starting to turn over again. But the U.S. continues to struggle. Like the Atlanta GDP estimates have walked back again. They fell about a little over 1% to about a 10% expectation for a 10% growth in Q4, and it'll essentially shake out as we see some of the Fed data starting to slow, some of the just general activity, and especially some of the leading indicators slow down, which will be a little bit of a headwind as we head into Q1. And what should we expect in 2021? And as you can see, like a lot of our trade partners, just generally starting to slow down, which again continues to weigh on some of the activity that we could possibly see within the U.S. Now, when we look at the Federal Reserve economic projections, and we continue to see inflation projections starting to shift higher. And it's something that we want to talk about, and we have several charts throughout the different the different shows but obviously within the econ segments, just seeing how inflation is increasing and how it's weighted, artificially depressed for things that you don't buy. And the running joke is like, look, if you drink oil and eat airline tickets, then sure, like you're seeing inflation come down. But when you look at things that you're actually purchasing, food, as we keep talking about food prices just continuing to shift higher, grain prices continuing to move up, these are the things that are really being impacted. People are feeling this in a big way. Healthcare, same thing. So that's where we're starting to see some of the PCE inflation starting to go up, some of the core inflation starting to tick higher. And those are the issues that we continue to see. And again, it's the fear that we have that inflation is going to accelerate as we're starting to see those pricing into some of the different curves. And why is that? Now, this is, I thought, a good chart just showing the interest in debts right now. So here you can see less than 0%. We're coming up to 30% of total volume out there, where most of it is essentially the lion's share starting in the end of 19 through the end, essentially the end of 20 is below 1%. With about, let's say the remainder, 27% or so is sitting there at anywhere between 1 and just over 3%. And again, this is the issue that we continue to see where, everybody is taking advantage of low rates. And this comes to the functionality of what is central bank buying. So let's just break it down, specifically in terms of what it is. So the government will issue debt. The banks will, or second intermediaries will then buy that debt. Then they will have the opportunity to go out and sell that debt to the central bank, and in return take cash. Now, do they actually have cash moved to their sheets? Sometimes, depending on what they need. If they need a repo, instead of going out there and borrowing at a repo rate, which is just the overnight rate, they'll just leave it at the Fed. So it's cash that is also sitting at the Federal Reserve that is allocated for that bank to meet either Federal Reserve requirements and or cash that they can take in. The only way that actually gets into the system is if they issue loans, and we'll show loans and loan growth and some of the issues that we've seen there. But without that loan movement, it's just living within a pocket. So again, it's not, we don't have a liquidity issue. We have a means of moving it through the system where it's there. It's fun to talk about because everyone likes to point to liquidity, and you can see as liquidity increases, so do rates, or I should say rates coming down, but equity valuations continue to surge higher. And again, these are things where when we look at liquidity and world equity market cap, they just continue to move in the same direction. But it's not actually moving into the system. It's not really stimulating the economy in the way it is essentially allocated to do so, which is why we're starting to see some of this pushback as to what happens next. So when we look at, okay, well, what happens next? Well, this is where we start to look at the different phases of the economic recovery. So here we had an increase of about 7.5%, and now we're getting that stimulus bill, which we'll talk about, which is at $900 billion. And we'll be very clear, we're going to separate out because now the comments are fair, and I appreciate people actually looking in and ripping apart a 5,500 page document. But there are two documents in that package. There is the stimulus bill, and then there's the federal budget, because they were all put together in an omnibus bill and passed. So you have to separate the two. So $900 billion is obviously to the U.S., but now because they were put together and people wanted to read it, you can see the amount of pork and insane spending we do to things that have a minimal bearing to the U.S., or at least some things that go to allies, and maybe they should be cut or they should be lessened. But you're seeing that is not part of the stimulus bill. That's part of the budget that the government has allocated for itself because it ends fiscal year September 30th. So, but again, this is the pain that we continue to see. So we needed this bill or this $900 billion to try to spark some sort of recovery because we've seen income fall precipitously. We've seen spending slow down. We've seen a lot of pain starting to arise, which is something that we're going to talk about on the savings side. So then when we look at COVID relief, so this is looking at expectations. So going from, into Q4, this is the overall baseline, but now the $900 billion is already factored in, and you're seeing some of the stabilization that we're expecting into Q1, or at least Bloomberg Economics is expecting. We continue to think that we're going to see a bit more of a slowdown, and even with the additional aid coming through, again, it's a one-time check. We'll go through the different components, but it's important to appreciate, well, what does that do for overall movements in terms of personal income, and how will that money be spent? Because so far, the data is saying that about 30 to 40% of it is going to go into savings because there's a concern that this will expire and there won't be another one, and we're not seeing this movement in jobs, which is, again, the bigger driver behind it. Now, when we look at the contribution, because we got the finalized Q3 numbers, contributions to percent change in real GDP by industry. Healthcare and social assistance is, I think, an obvious one. Durable goods, again, people were going out and essentially stocking up and buying things, as we talked about, from going from the urban to the suburban and those build outs. Food service, nothing crazy, but retail, trade, wholesale, those are things that we've seen slow down aggressively as we lost the stimulus, as some of those checks, whittled away, and now we're starting to see a rejuvenation in inventories, which is starting to slow down some of the overall movements, and then we see some of the acceleration to the downside in a lot of these others, to the point where, again, arts, entertainment, all of those inflationary components continue to go away, with construction being very obviously weighted towards residential and not towards commercial. So this just gives you an idea of kind of where those growth points are, and looking at it in different ways, difference versus pre-COVID on a percentage level. You continue to see that the durable goods are a big driver, but when we look at services, those are the ones that continue to see pressure. Structures, so it's exports, imports, the general trade just continues to be under pressure. And government spending is starting to pick back up. Obviously, that'll start to accelerate. But again, trade and just general spending on the consumer level, because we know that the companies are being cautious. They're not investing the same way, even though banks technically have the money to do so. But it's a mixture of banks are unsure, corporations don't really have a clear direction, and that's where we're starting to see this kind of hiccup, which is, again, really reverberating through that fixed investment side, which is going to be an overhang. So between trade and fixed investment, and then the slowing consumer, again, which is why it's not something that is just going to go away as we go into Q1 and close out the year. And this is just looking at it in a slightly different way, looking at intellectual property, some of these things in terms of fixed investments, which is the overarching problem that we continue to see. But the consumer spending is where we want to look at, because durable goods, the question will be how many durable goods, or can we see a continuation of durable goods really materialize as we've had first wave moves, where you have someone who's moving from an apartment to a home, you buy all the stuff that you need for the home, you buy the car that you need because you're going to need a car to move around instead of using mass transit, but how many times are you going to do that? What is the continuation that we should see? And that's where, when you look at who took out mortgages at 760 or better on a credit score, these are things that are going to be an overhang, because that second wave is going to be hard to see over the at least through the first quarter. And here's just a quick backdrop of about 1 in 2 voters say $600 in stimulus checks is in relief isn't enough to boost the economy. And again, it's because people are already so backlogged with just bills that we're not going to see this movement through the system, which is why when you look at what President Trump said, where he said, look, I'm going to veto this. I'm going to send it back. Send me something that has a minimum of $2,000. And Congress was like, but he said, take out the pork, give more money. Instead, they'll keep the pork and just give more money, just add some zeros, have the printer turn back on, and they'll just issue more debt, have the Treasury buy it, or have the Treasury issue more debt, have the Fed buy it, and just continue to try to push this through the system. Again, these are the functional problems of how do you get cash in hand, where do you move it, and you can see that it's pretty much across the board that everyone says this isn't enough. This isn't. Even the fiscal people that are used to be fiscally responsible are saying this isn't enough as well. So again, the $600 is going to be tough, and we're going to go through the specifics here, because when you look at, okay, well, one-time $600 payment to most Americans, right now the level was at $75,000 a year and less. Extension of the pandemic unemployment and emergency unemployment. We'll talk about why that's important, because we continue to see more and more people going onto those programs. The extension of $300 per week and additional unemployment benefits, that is now through mid-March. So that was supposed to expire in 3 days on December 26th. That now goes to mid-March. $284 billion for the Paycheck Protection. An additional small business funding worth $35 billion. Again, that's where we're going to see more people have their paycheck protection forgiven. A lot of companies that took out those paycheck protections or PPP loans, they have started to go bankrupt. So it just extended. It gave life extension, but again, we haven't seen that turnaround in the economy. So even though they got it, it wasn't enough. Extension of federal eviction moratorium through the end of January, plus $25 billion for rent. It was just supposed to expire January 2nd. It's now going to go to the end of January with some assistance for that backlog. Up to $68 billion for vaccine distribution. Again, trying to make things free, trying to get people to incentivize, try to get that normalcy. $13 billion food stamps. We'll talk about why food is a huge problem in the second and third segment. $10 billion for child care assistance. Again, we're going to talk about why that's so important, because people at people at the lower end of the income level are spending more and more on child care. And which is again, $600 to me or to someone else, it can go into savings. But for someone who's living paycheck to paycheck and doesn't have school or doesn't have the ability to afford a babysitter, they need to spend additional on childcare, because childcare costs are going up just to protect for COVID. Again, a lot of issues there. $45 billion in transportation, highways, transit. Again, finally starting to see some move into infrastructure. This is where we can start to create some jobs. We need broadband internet as for students, for K-12. And colleges, again, this is all a huge problem. Anybody who's been trying to upload, as we do these shows, we try to upload previous ones that we've filmed, and it's going slow. So again, we need some infrastructure, and $13 billion to agriculture. And now just to kind of put it into a backdrop of selected relief categories, this gives you an idea of who is getting those benefits. And the small businesses continue to be the beneficiary as well as the direct checks, but the small businesses continue to struggle, where we continue to see that bifurcated system, which we'll talk about again with the revenue and where the small business revenue is being lost. Because even though they're getting more support, it's just not generating enough, because we're not seeing people spend enough, which again, you're getting a shot in the arm, and it's just prolonging what is appearing to be the inevitable, but trying to get to the other side. And that's why this is going to be something that is going to be meaningful to where do the direct checks go? Is that going to be enough to try to support small businesses, because they continue to struggle to get to the other side, as the economies of scale is a benefit for the larger entities. And especially if you look at, and we'll talk about secondaries, and we've talked about the debt market, where if you're a large corporation, your ability to issue debt has been fantastic. And you can just take in, I don't want to call it free money, but we can call it free money just given how low interest rates are. And, just based on inflation expectations, you're going to be better than inflation. So again, these are things that are beneficial for large corporations, but small businesses continue to struggle. And that's why when we look at U.S. State Recovery Tracker, you can see that we have that bounce coming out of Thanksgiving, but we're seeing that slow down as we head into the into Christmas. And again, this is why we didn't get back to pre-Thanksgiving levels. Instead, we slowed down, and now we're actually rolling back over, which again gives us it causes us to have some concern, as you know. Obviously, this was driven also by the concern about no stimulus. When will stimulus come? How will stimulus be dictated? Who's going to get the money? But now that we have, a lot less than was initially promised or expected, it started as an agreement of 2.5, then it was 1.8, then it was 1.2, and now it's 900. Well, what happens, going forward? And that's why we need to see more. And Trump just vetoed the bipartisan defense policy bill, so there's a lot of going to be pushback in terms of where does this spending really originate. And that's why when we look at what the CDC is saying, coming back to activity, you can see that has advised Americans to not travel. Obviously, people will travel. It's just you're going to get less of it. People won't be taking the trains as much. So trains, buses, planes, maybe driving a bit more, but even then it's going to be smaller. I know from my, personally, we normally have a very big Christmas Eve party. That won't be happening. It will just be nuclear family, and everybody has, been cautious, living in a bubble. So again, 22% canceled. 16% saying haven't canceled, 59% I didn't have travel plans for the winter holidays. Again, people already expected to do nothing. And then 22% that thought they were going to do something are no longer going to do something. Again, so you can see that over almost 75% of people are doing nothing. Again, leading to oil demand, gasoline demand, not being there, and that slowdown overall going to continue. And that's why when we look at U.S. high-frequency data, it continues to get worse across the COVID side. Lockdown restrictions continue to accelerate, as we've seen in the West Coast, as we've seen across different parts of the U.S. That is not going away anytime soon, and it'll really maintain through the end of the year. And we don't see a big adjustment as we head into year end, as the jobless claims got a little bit better, but again, they got much worse. So they got worse by about 32% or so, and then they got a little bit better. But again, we had the claims got worse, and then even though they surprised to the downside, they surprised better, it still wasn't enough to take away the gains that we've seen in unemployment, which is again that overarching theme. And then as we turn to India for a minute, where even though the COVID cases continue to get better, we're seeing lockdown indexes getting a bit worse. There's a lot of concern about the UK because India and the UK have a lot of trade and a lot of back and forth on flights. So that has locked down. And even though Diwali, which we'll show, actually didn't result in the spread that was expected, we did have pockets. So again, that's why we're seeing this index increase, and that's impacting consumer sentiment as diesel demand is falling because trucking is moving a little bit less. Trade actually surprised to the downside. Inflation still remains elevated again, which is which is acting as essentially a big headwind for the Indian economy, which, as we saw in the high frequency data, continues to be an overarching problem. But as we look at 2021, investors are confident that currencies, bonds, and stocks will rise, because why not? Stocks don't go down, so they'll just go up again. Everything has been based on the dollar. As the dollar goes down, all else goes up. Even bearish data makes the market flat. Bullish data sends the market to all-time highs, and that's continuing to what we're seeing. And again, this is more of a liquidity question. There's a lot of hope in the fact that the vaccine will do something, and that we'll see this big surge. And you can see that the expectations across the Bloomberg survey of 63 investors, traders, and strategists think we're going up and away. And the same respondents expect economies to bounce hard in 2021. And you can see that all of them are expecting growth pretty much across the board. Again, because 2020 was so low, we'll have some growth year over year. But as we kind of normalize it versus pre-COVID, we just don't see the same type of excitement that we've seen, or at least they're expecting, just given a lot of the data that we're looking at across trade, across high frequency leading indicators, and then how is that going to affect some of the lagging indicators and just spending activity as we can have continued to stimulate the economy. Japan for the last 20 some odd years, the US for the last 10 to 12. at some point you hit a means of law of diminishing returns, and we've already seen it just given the sheer size of the stimulus, and that's going to, again, put pressure in terms of where can this go and what can that really look like, which is why we continue to see secondaries and guys capitalizing on the elevated pricing. But that's something that we're going to start off with in segment 2, because it's a good way to kind of transition the two and lead into what spending will look like for the not only just the remainder of the year, but also for at least the first quarter of 2021.